Definition of a stock index. A stock index is a measurement of the performance of a group of stocks, often representing a particular market or sector. It tracks how the selected stocks perform over time, providing a snapshot of the overall market or industry. How stock indices are formed. Stock indices are formed by selecting a group of representative stocks based on specific criteria like market capitalization or industry sector. The performance of these stocks is then averaged to calculate the index's movement. Popular stock indices. Some of the most well-known stock indices include the S&P 500, which tracks the performance of 500 large U.S. companies, and the Dow Jones Industrial Average, which monitors 30 significant U.S. stocks. Each index has its own selection criteria. Tracking market performance. Stock indices reflect the overall performance of the stocks they track. When the index rises, it typically indicates that the stock prices within it are increasing, signaling economic growth or a bull market. Calculation methods of stock indices. Stock indices can be calculated in different ways. The most common methods include price-weighted, like the Dow Jones, or market capitalization-weighted, like the S&P 500. The method impacts how individual stock movements affect the index. Benchmarking and comparisons. Investors often use stock indices as benchmarks to compare the performance of individual investments or portfolios. If a portfolio outperforms the index, it signals that the investments are doing better than the overall market. Role in investment strategy. Stock indices are crucial tools in developing investment strategies. Index funds and exchange-traded funds, ETFs, allow investors to invest in a broad market segment, reflecting the performance of a specific index without buying individual stocks. Reflecting market sentiment. Indices help gauge investor sentiment. A rising index generally reflects positive investor outlook, while a falling index may indicate concerns about economic stability, corporate earnings, or geopolitical risks. Use in economic analysis. Impact of global events on indices. Global events, such as geopolitical tensions or financial crises, can affect stock indices significantly. A sharp decline in the index can reflect market anxiety, while an increase may signal resilience in the face of uncertainty.